Peter Rose, Longwood Currency Trading. It's first week of April of 2021, and surprisingly, it's surprisingly cold. I just came from outside, and I thought, well, I'm not going to be doing a walk around video today. I'll just do it from the library. This video, I wanted to talk about positive expectation in your trading. And to have positive expectation, you really need two things, or to develop a sense of positive expectation. You need a set of metrics that you can look at and rely on to give credence to this expectation that you have. And the second is that you have to have a clear vision of your goals, your trading goals. Those two things, I think, are really critical for positive expectation. And I'd like to go back a little bit very briefly and take examples from my 40-year career as a real estate investor and how I developed positive expectation through that. And of course, it wasn't the real estate that gave me the ability to learn how to develop positive expectation, but rather all of the years at that point. I'd had 10 or 15 years in martial arts and karate, and I'm still involved in karate 50 years into it. Because that all assists in that positive expectation. Rudimentarily, you can say that I have a positive expectation because I'm good and I'm going to succeed. That's the emotional part. The metrics has to do with, in trading, for example, the win-loss ratio is the mark of that ability to have a positive expectation in your trading. In real estate, it sort of comes as a cumulative experience, like it would in trading, where the more deals that you do, the more that you can expect to succeed, as long as you did succeed. And if you didn't succeed, you need to have a very clear picture of why it didn't succeed. You can't just say, oh man, I really screwed that up, that was really stupid, because that doesn't allow you to build a good feeling. It just makes you feel stupid. But if you say, man, I bought that building and the tenant, I didn't check, and none of the tenants have any leases, and they got dogs and they got 14 people living in a unit, and it's stupid. That enables you to write that down in your little book of shit not to do, so that the next time you buy, you can say, I'm now going to be able to prevent all the problems that I'm going to run into with this building, because the next time I go in, I'm going to make sure that the tenants have leases. I'm going to want to look at the specifics of each lease, because sometimes different tenants, even in the same building, will have different clauses in their leases. For example, I had buildings where you had some apartments would have one designated parking spot, and others would have two. So you really have to look at that particular type of situation. And the only way you're going to learn to do that is either have to have a mentor to say, hey, Slick, you better sit down with your lease roll and go through those documents and see when are all the leases up, if there are leases. If all the leases come due at the same time, it means you're going to be 100% vacant if they all decide to leave. So without having the experience in real estate, how would you know to do that? And so you're going to make a mistake with that, with that building. And so you can bemoan your fate and wring your hands and blame everybody under the sun, the broker that sold the building, the seller that didn't disclose, whatever that stuff is. That's not their problem. It's your problem. And it's the same way in trading, right? If you don't have somebody to tell you to put a stop loss, why would you think to put a stop loss? You'll get out when the profit is realized. you're not really thinking in terms of the loss and the number of times that you may lose and the amount that you'll lose in relationship to the number of times that you'll win. And so you can learn that the hard way, or you can read a book or watch a video. The problem with doing that is the same problem that I ran into when I started in real estate. Fortunately, I had a karate student who was a real estate broker, and I'd chat with him about that. I get interested in real estate, started reading books on it, and came up with these questions that I'd go in and talk with my friend about. And he'd go, oh, now you don't need to worry about that, but I'll tell you what you do need to worry about is this. And I go, well, yeah, but that's chapter 6. Well, he said, that's wrong, because that really needs to be up front. What the authors of the real estate books, as well as authors of trading books do, is the subject is so broad that it's very difficult to put the 5 top things you have to do up front without setting the stage for that. To tell somebody, right up front, well, you need to have a one-to-one risk, reward to risk ratio. That's meaningless unless you put it within the context of trading and the number of times that you trade and, all that sort of stuff. So when you're doing a written form of instruction, you have to trust that the person is not going to read the first 2 chapters and then going to start trading or start buying real estate. So now you have to read the whole book. And because a book is going to be 200 pages or whatever it is, or a course, there's so much stuff in there that how do you differentiate what's important from what's not important? Or what's important, and it isn't that the other stuff isn't not important, but it's ancillary material that builds up the importance of the main theme that you're trying to get across. And it doesn't do any good if you have chapter headings that head that stuff up and speak directly to that. That's a lot like baking. You can have a book on how to bake a cake, but man, the person is just going to get bored out going through a 200-page tutorial on how to bake a cake. They just look at the back of the recipe box and let's do it. And yeah, you might get a cake or whatever, but if you really don't understand, and I'm not a baker, flour to water ratio, the egg involves what that does to bind things together, and if you don't understand all those pieces, you're just not going to do a good job. And in real estate investment, you can read all the books in the world that you want, but when you go out to buy that first piece of property, take it from me, if you don't have somebody who's successfully invested in real estate, put their cash on the line and gone through all this stuff and knows what the stuff is, you're not going to be successful. And in real estate, you put up, at this point in the game, $30,000 to $300,000 as a down payment to get involved in a deal, even a 4-unit building. I just sold a 4-unit building for $600,000. Don't think that guy put up $1,500 to buy that building, right? So there's a significant amount of loss waiting for you if you get it wrong. And because most of the time when you go in, you have these large down payments that have to be made, there isn't the cash left over to solve mistakes. If you didn't know, for example, that you should have gone around in each apartment and made sure that there's no cat piss on the floors, that could cost you a couple of $1,000, $3,000 to fix. I had an apartment building one time, and I had a no pets policy. I came in to collect the rent, and I smelled cat urine, and that was it. That tenant was out of there, but the cat had peed in the same place all the time on the carpet. The carpet had leaked through onto wooden floors, And not only did the carpeting have to come up, but the subfloor underneath had to be cut out and a new piece put in because you couldn't get the stink out. So that's a costly mistake. And if you don't have reserves after you purchase the property, how are you going to fix that? And if you can't fix it, you can't rent it. So in currency trading, look at the advantage that we have. You play with 5% margin, and so if you're trading a full lot, it's like $100,000 currency pair. You put up. You'll need $5,000 as your margin. That's why if you're going to trade a full lot, you need $10,000 to do that. Could you make a trade on $5,000? Yeah, sure you could. But if the price ticks 8 or 10 pips against you, you can't go back in to make that trade. You're out because you don't have enough margin. So that's why you need the buffer. But if there isn't somebody there to tell you about that, and you fail, where do you get the positive expectation that you're going to be able to succeed? How are you going to have enough successful trades and unsuccessful trades all mixed together so that you survive long enough to develop the metrics that we talk about when we say that these are the metrics that we need, for example, the win-loss ratio, that you need in order to develop this positive expectation from a metric sense. You have a metrics positive expectation, and you have what I call vision, the vision of your goal, that it's a positive expectation. You have to get the metrics down first in order to support that vision, because otherwise that vision is just you sitting there going, I'm happy, I'm going to make it, I'm going to be a good trader, the next one's going to work. It's not going to work, and you're not a good trader. You're fucking kidding yourself. The positive expectation is gained by experience. And the only way you can gain experience is to have a set of rules that will allow you to survive long enough to make enough mistakes that you don't go broke, that you can continue to trade after you learn from your mistakes. And that was Jesse Livermore's advice. The only way to get a real education in the markets is to invest your cash, track your results, and learn from your mistakes. That's what you have to do. The result of that is not only a metrics positive expectation on your trading. In other words, every trade that I put on, whether I win or whether I lose, it's just the fact that I put that position on. My expectation is that I'm going to win 3 pips. So if your system is good enough and you just traded the bare bones, you get an average of 3 pips out of every trade that you place, that you put on. Now, some trades will make you 50 pips, some will make you 200 pips, you'll lose 1,000 pips, whatever all that is. But because you've done it over a long enough period of time, you have a positive expectation of 3 pips per trade. Every time you put that position on, even if you lose it, you say, well, I just made 3 pips. Because the next trade will make 6. And then you've got an average of 3, right? So, except you can't do it over 2 or 3 or 10 or 20 or 100 trades. When I advise a student in working their metrics, particularly somebody who's beginning and starting out, I mean, if you make 50 or 60 trades, you have no idea what you're doing for the first 50 or 60 times. So any metrics you come to in those first 50 or 60 trades aren't worth shit. They don't tell you anything except what a dope you are. So you got to have about 300 trades in order to say, oh, I've got a win-loss ratio of about this, so I have a positive expectation, X number of pips per trade. And so you have to have that other aspect of positive expectation, which is the vision that enables you to go forward. And again, it isn't just a vision of where you say, oh, I'm going to be successful at this and I'm going to be able to buy a Lamborghini with my trading. That's not the positive expectation. That's the expectation you're going to have if you don't have a mentor working with you. And you'll have no positive visioning if you're reading books or just reading courses, because that isn't part of it. All that can do is give you the mechanics. But you're a person, a human being, and you have to interact with the mechanics. You can go out and turn your car on and drive down to the grocery store, but if you're not paying attention or know the rules of the roads, you're gonna blow the stop sign and somebody's gonna broadside you. And then, how do you develop a positive expectation of driving then? It's just a big, huge failure. How do you recover from that? Oh, I was stupid. I didn't know the rules of the road well enough, or I didn't really understand the ramifications. I know there's a stop sign there, and that person should stop there, but what happens if they don't? If you didn't have somebody telling you that, how would you know? You absolutely are going to have somebody to run your ideas by. And you can't take offense when you say, oh, I just come to this great system. It's called moving average crossover system, except instead of blah, 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 I'm going to do this. And the mentor's going to go, what, are you fucking crazy? You know, trading's been going on moving average crossover system for 1,000 years. And you're gonna come up with a new flair on that? I don't think so. Here's what you can do. You always have to be willing with here's what you can do. But you don't get that in the books. And unfortunately in trading, the guy that's on the video or the person writing the book is going to show you instances in the chart patterns, whether he really took the trade or he's just hypothesizing and showing you an example. They're being very successful with whatever system that they're proposing. But you can't duplicate that because it's not based on a moving average crossover system or a Bollinger Band or an ATR. It's not based on any of that shit. It's based on the person's experience, their positive expectation based on that experience from a metric standpoint, their positive expectation based on their correct vision of what their trading should be like at any given segment of time in their learning experience period and then going into the more experienced periods. Why do you think the really successful traders say that it's easy? Or it's not easy, it's simple. The trading is not easy, it's really difficult, but it's simple. Why do they say it's simple? You're coming into trading and there's all of those indicators and all of these methodologies and this guy is saying this and that guy is saying this, and how do you differentiate, how do you unscramble all that information? In my introductory video, I talk about if you have 5 indicators, just 5 indicators that you're trying to make corollary decisions from, those 5 indicators can be arranged in over 300 different permutations. If I had 2 things, A and B, I'd have 4 permutations, right? Not 2, I'd have 4. If I had A and B as my 2 things, I don't have just 2 ways I can arrange them. I can have A, I can have B, I can have AB, and I can have BA. So that's 4 permutations with 2 elements. If I go to 5 elements, there's over 300. I think it's 325 different permutations you can have. Well, I mean, that's just crazy. That's just stupid. Even having 2 indicators where you're looking for confluence and stuff, you have 4 possible configurations those 2 indicators are in. And that doesn't develop confluence. Having one indicator confluence on the other one is not confluence. You have to have 2 confluences on the indicator that you're looking at. And which indicator is the more important of the 3? That's where you come into it. So I can't calculate what those 3 are. It's, I don't know. Let's see, one is 4, 16 or 18 permutations of 3. Whatever it is, I don't know. Doesn't make any difference. You can't develop a positive expectation of your trading from that. And if you get in to your trading and you don't know what you're doing, or if you've been trading for a while and you have no idea why sometimes you're successful and why sometimes you're not successful, and you just wrap that off to the gods, you don't really have the ability to create a positive expectation, vision for yourself. When I take a student on, and I don't want a lot of students because I have to work with them personally, and I don't have time for that. I'm 72 years old. I don't have time to be tied up with 1,000 people a year or whatever it is. I mean, I could, but I'm not going to. My time is far more valuable from what I could charge somebody than I could get from my own trading or just enjoying reading a book because I'm retired. I don't give a shit. I'm sorry. That's just the way it is. But you better pay attention to what I'm saying in these videos and look for these characteristics in yourself, and look for the characteristics of someone who might be offering you advice, or look for the advice in the books and the videos that you are using, and when they answer these questions for you, that's a good reference. You know, there are folks that are out there that are putting good videos on. You might have to, like in my case, I think my videos are good, but taken individually, probably not so much so. But if you look over at the entire body of work, then you're going to be able to benefit from that. But you have to look at a video. Did I resolve an issue? Or did I bring something forward in your mind that you need to go out and do more research on? Because I'm going to be the first person to tell you that there's no, in fact, I just did the last video that I did was based on rules can't be static. You can't have static rules. And this is where your positive expectation comes into play. Your ability to be positive in what you're doing, knowing that in the long run, everything will come out okay. Everything will be okay because everything's been okay for a long period of time, a long enough period of time to tell you that you know what you're doing because you have a positive metric expectation. And that gives reinforcement to the vision that you have. Well, what is a vision of your trading? I mean, this is really the critical element to the whole thing. This is the glue that brings it all together. A vision is not just sitting there going, oh man, I want to go sailing and I want to, I'm going to sail to the Caribbean from Boston. That's a nice vision to have, but it's unrealistic because you don't even have a boat. So if I was going to have a positive expectation of my ability to sail from Boston to the Caribbean, I'd be online doing a lot of research about what would a boat have to look like in order to get from Boston to the Caribbean. What kind of boat would I have to use? I couldn't use a 18-foot O'Day day sailor to do it. I mean, you could if you were fucking out of your mind, but for all practical purposes, you wouldn't want to do that. You probably wouldn't want to do it in a 24-foot boat. Probably the smallest sailboat that you'd want to try something like that in is a 30 or a 33-foot, maybe a 27-foot would be the absolute minimum because you just don't know what you're going to run into out in the Atlantic. So you'd investigate the type of boat that you'd need. Do you need a Jenny, or is just a regular jib enough? Will you need a storm jib? How many reef points are you going to need in your mainsail? Do you need automatic steering? Or where are you going to sleep? You look at the coastline. Where are the places that you could pull in? Because you're not going to go from here to from Boston to the Caribbean in a day or two, So you start making these plans, and as you make the plans, more problems come to the forefront, and so you solve that problem. Well, it's not going to take me 2 days, 2 days to get there, 24 hours or 48 hours or something. Well, I'm going to have to pull in somewhere, or I'm going to have to sleep. Now, how do I do that? So that's a problem. So you solve that problem. So, well, this is what I'll do. Is that solution practical? Have other people done that? Have they been successful with that? Okay. then I have a positive expectation that I've been able to solve that particular metric issue. And by doing that, by going through this dry labbing, you can build a vision of yourself sailing from Boston to the Caribbean. And that's what I did in real estate. I read the books, I talked to my friend, I saw the problems that were involved in the properties that he owned and the properties that he managed for other owners. I talked to other owners and real estate investors and started going around, and as soon as I had a general idea of the information, not the methodologies, not the systems. I'm not a believer in doing something the way somebody else does it. I want to base my information on what everybody else does, but what I do, I want to call out the best pieces of all that stuff for me, because it's my fucking vision, not theirs. And that's what I did in real estate. And I did. It didn't take me long because I knew what I needed to do. I was involved in the martial arts, and that's what we need to do. You don't go into a bar with fear, or even into a restaurant and have fear because somebody's going to notice that fear and they're going to come after you. You have to have a positive view of your abilities and say, I don't really have to fight because that guy's going to catch it as bad as I do. So I may get my ass kicked, but the other guy's going to put some skin in the game too, and so I'm not afraid. And when you're not afraid, you disappear from you disappear as a victim from the eyes of people who would be your opponents or people who want to pick on you. You know that if you go into work every day and you're scared about your bosses and scared that you can't get your work done, they're going to make your life miserable. Miserable. I worked as a software engineer for 33 years. And there isn't anything more than mine gets bigger than yours in software engineering, because you get some really, really, really smart people. And the more information they have, the bigger the egos they have. And they just make normal folks like me look stupid. So I got really good at a certain area. And when somebody would say, you didn't do this right, I'd say, yeah, you're probably right. How can I make that better? Help me. And that made that person feel good, and I learned something. But nobody could tell me how to make this better because I was the best at that. I had a positive vision. I had a positive expectation of that. In fact, I was so positive about things where all of my co-workers, when they wanted to take a couple of days off, they'd go in and they'd put a request in for the day off, and sometimes they'd get it and sometimes they wouldn't. I never did that. I never did that. I'd walk into my boss's office, the guy that's on the, maybe 2 levels above me, and I'd say, hey, I'm going to take next Thursday and Friday off, so I wanted to come in and see if you had anything on your calendar that you might need me to do before that, so that I can help you out with whatever needs to happen, but I'll be gone next Thursday and Friday. I'm not asking for permission. I'm fucking leaving on Thursday and Friday. I'm not going to be here. And if the guy said, well, it's not going to work very well for you to leave, for you not to be here on Thursday and Friday, I say, I know, probably not. That's why I need to work on whatever needs to happen now, because I won't be here. I won't be here next Thursday or Friday. And the only time I would deviate from that if my boss would say, hey, well, wait a minute, we were scheduling a major release for for Friday, so we really need you here for that. I said, okay, I can change my plans for that. I had a positive expectation of myself, not about a job or whatever, but I had a positive expectation of myself that I had no fear about going in and telling somebody what I was going to do. In trading, you have to have that sort of visioning to develop the positive expectation that you can sit down at the trading desk every day or every third day or whenever it is that you sit down at the trading desk with the expectation that you're going to be successful. And successful is making good trades, but some of them might not work out. You always want to make a good trade. Don't ever make a bad trade. You make good trades that work out, and you make good trades that don't work out. That's the vision of someone who has a positive expectation of their trading. I've suffered horrendous losses on trades, taken my account down so many times, and I sit down the next day after I take that beating and I go, I ain't gonna do that one again, and I start trading. Now I may trade with smaller size until I get a couple of good trades under my belt, but then I pick it up and go from there, because I think positively about the long run for my trading. Now again, I haven't been doing serious trading since probably 2000, well, I mean in 2017, 18, I lost my first live account. It just went, because of all the factors that I've stated in my work before. And then I had to step back and do more just general simulation trading until I figured out if there was anything mechanically I was doing wrong. And then I got back in with some mini lot trading so that I'd have some skin in the game, trading a real account and working my way through and trying to develop those skills and losing money and going through. And then just recently, at the first of 2021, refund, we're starting over again with, I sold a piece of property, and so I had enough money that I don't have to worry about my account size anymore. And so I'm trading with a small subset of that. It's significant money for most people, but it's still a small subset of the total amount of bank that I have. And so although I may take horrendous losses against that from a dollar standpoint, and even a percentage standpoint sometimes, well, I mean enormous percentage standpoint of the balance that I'm trading with, the immediate balance I'm trading with. In the overall picture of the thing, it's not as bad as it's not as bad as it looks. You know, it's like a car wreck. You know, a fender bender, bang, and everything shakes. But you know, you get a little dent in the fender. So even though I've taken some really bad losses, I took an $8,000 loss a while back. And I still haven't recovered and brought the thing back. But the day after well, it wasn't just one loss. There was two of them that contributed to bringing the account down that much. But there was one day where I was at a $5,000 loss. I took a $5,000 loss. And the next day I came in, I sat down at the computer. I felt good about myself. I knew why I had made the mistake that I did. Turned the computer on, got my trading platform up, and just traded 3 minis for the day. And then the next day I went back, traded a full lot, and then gradually started to work my way back up through. But never, other than while I was watching price go way against me and going, what is the matter with you, did I really feel stupid about myself. You take the loss, you take the hit. It was a stupid thing that you did, or it was something that you understood. It doesn't matter. That was yesterday. I have a long history of successfully trading, and then I'll take a big hit and get knocked out. I just have to figure out how not to take those big hits. That's what I'm waiting for. And so I've only really been dealing with this from a rational level with a large enough account in order so when those losses, when I lose, they really hurt. So they really draw your attention to what's going on. And when you win, the wins are significant enough to overbalance the losses. The problem is when you're just starting out and you're getting this stuff up, you tend to cut your winners a little too short, and those losses run. And so, you know, I'm behind, but I don't feel badly about that, and I don't think that makes me a bad trader. I think that for the time in doing things in the correct manner since the 1st of 2021, basically, 4 months, 3 months, really. We're just starting April. Life is good. I have a positive expectation of that. I've seen this in my real estate. I've seen this in my martial arts. I saw it when I was learning classical guitar. I saw it when my dad was teaching me how to sail a small boat when I was 10 years old. I saw it when I was learning how to play chess. My dad taught me how to play chess when I was 7 and working my way through. I see this stuff. I don't remember how to play chess today. I used to be okay. I could probably sit down and I need to play about 10 games to get the general ideas back. But I don't have any expectation I'm going to win against anybody that's been playing, but I still have a positive vision of myself and enjoying the game and learning, and losing is just part of the learning process. And if somebody is on the other side of the board goes, "You stupid asshole, you did that move," I'm just going to look at that guy and say, "Hey man, you give me enough time, I'm going to take that move, I'm going to shove it right up your ass." And so I think the same way about the currency trading. Once I gain that metric positive expectation, which I don't have now because I haven't done the necessary number of trades trading at the level that I'm at, but once I'm able to develop that positive expectation, why would I have any fear? Now you look at the folks that are doing videos and writing books and so on. The folks that write books tend to know what they're doing, and the books tend to be very helpful and very good, because dopes and charlatans don't write books. They don't know how, they're too stupid. And books get easily reviewed in the global framework. I mean, if you're buying a book off Amazon, you can read all the reviews, and if you have 300 reviews and 298 of them say this guy sucks, he doesn't know what he's doing, that book doesn't last out there. And so, but that's not the case for the videos. So you have to be very careful about that, because oh man, I got to say probably 95%, maybe more of the folks that are making videos out there have no clue. Some of them don't trade. Some of them, all you got to do is make 2% a day and you'll be a millionaire. And so many, I mean, the guy that did that video is just, I mean, I think that is just that's a scam. Trying to build up his course, and you're paying him thousands of dollars to learn his methodology when his whole pitch is stupid. You really have to be careful about what you believe and what you follow. How do you build a positive vision of your trading experience when you have some asshole out there telling you all you have to do is make 2% a day? 2% sounds like nothing. If I had a $1,000 account, what's 2%? What is that? It's $2. How tough is it to make $2? It's 2 pips. All you got to do that is you make 2 pips. That's all you got to do. But if you make those 2 pips, then the next day you're making 2% on a larger number. So now it isn't 2 pips, it's maybe 2.1 pip. And eventually you get to the point with these systems where the 2% is, you got to make 2% on $5,000, $20,000, $50,000, whatever it is, on a daily basis. And if you screw it up and you're not careful about your risk management, boom, you're just in the toilet. Any dumbass can sit down with an Excel spreadsheet and show you how rich you can be by doing just this. It's like the guy that says, "Oh, I'm an expert marksman. I can pull that pistol out and I can shoot a strawberry off a cow's head at 100 paces." And the corollary to that is, yeah, but can you do it when the cow is shooting back at you? That's the difference. And that's what's happening in the currency markets. You're not trading against a bunch of dummies out there, because the dummies lose their money. You're competing against the large institutional traders, the hedge funds, and they're not even trading for the same purpose you are. They're not even trading the same way that you are. And there's a lot of the retail traders who take courses from the people that came out of bank trading. They're trying to teach you how to trade like the banks do. But the banks are trading for totally different reasons and using totally different methodologies than we can as retail traders. We can't trade like the banks. We're not providing liquidity for some commercial entity to sell one currency and buy another so they can transact some sort of business. We're just trying to make a few pips. It's ludicrous. It's stupid. And all of that, unfortunately, goes to preventing most of us from being able to develop a positive expectation or having a positive vision of what our trading experience is going to be like. You know, if you had a $1,000 mini account and you could make $1 a day, every day, that's all you needed to do, averaged out over the month, you make $1 a day. You'd make $30 on that. Well, you wouldn't. You'd make $20 in a month because you only have 20 trading days, right? But $20 a month is 2% on that $1,000, and you don't compound. You just each bet's $1,000. So you got to have probably 2,000 in your account so that you constantly bet that $1,000 and you don't have to do that compounding. That's just crazy if you're doing that. But if you could just get 1 pip a day, on $1,000, on $10,000, on $100,000, it doesn't make a difference. It's 1 pip a day. So 20 pips a month, trade for 10 months, you get 200 pips. So if you're trading a $1,000 account, that's $200. That's 20%. If you're trading a $100,000 account, that's correspondingly a larger size because each pip is worth $10. Now you've made $2,000. It's the same 20% on the $10,000 account. You trade a $100,000 account with $100 a pip, and you make 200 pips. It's $20,000. So on $100,000, you make $20,000 a year. It's 20%, but it's $20,000. I mean, be realistic about what you're trying to do, and don't trade with a $20,000 account when you start, or even when you're low intermediate level. Trade the minis. Trade 1 mini until you have a positive metric expectation that you're going to make $1 a day or $3 a day. My positive expectation is make 0.5% per thousand, which is $5 on $1,000, $50 on $10,000 account, trading full lots. But to make 0.5% every day I trade. Now I don't trade every day of the week, so if I trade 3 days a week, then my expectation is I'm going to make 1.5% a week. Is that reasonable? Well, maybe not. Because maybe the next week I'll lose 50 pips. But in the long run, if I could just make that 0.5%, that 5 pip move, capture 5 pips a day, without going into some 40% drawdown or something. If you look over the say a 300 trade sample size, position sample size, and you divide out the 300 positions into whatever number it is that you netted at the end of the year, and that comes out to 0.5% per trade, man, you got the whale by the tail. There's no reason that your positive expectation that your vision isn't fulfilled and that your positive expectation allows you to sit down at that computer and make the trading simple. But if you don't make it simple to start with, how are you going to simplify it later? You're not. And that's been my problem as an engineer, a software engineer for 33 years and a real estate investor. All this shit is complicated. So a complicated problem takes a complicated solution. I'm an engineer, so I try to find the complexity in these markets. There isn't any. It's simple. You just can't look at it intuitively the way that you would look at real estate investment or sailing a boat or baseball or anything else. Your instincts are wrong in your currency trading, the way that you're wired up as a human being. I'll just tell you that right now. And that's why the bank traders make money, because they're not encumbered by that instinctual problem, because they are solving complex problems that need complex solutions. And they win. But that doesn't mean that they beat us. If we go and try to play their game, they're going to win. I guarantee it 100%. Look, I got a degree in physics and almost a minor in math. I can figure this shit out. You can't play the winner's game and expect to win, because you're not the winner. You have to figure out where your strengths and where your abilities are. If you go in the market with $20,000 and think you're going to make $20,000 a year off that, you're fucking crazy. Only when you get really, really, really experienced might that be possible for you. But you're going to have to compound, and you're going to have to take a little bit different kind of risk. That's a whole different ballgame than the way I'm trading. I'm trying to make my trading as simple as I possibly can. And the way that I'll make a lot of money is by having a large account. I'm not going to try to take a $20,000 account and make $300,000 with it. Want to take a $300,000 account and make $100,000. Maybe it's the same percentage, but of that 0.5% a day, it's just a bigger bank. Again, if I'm getting 0.5% a day on a $1,000 account, you make $200 for the year. If I had a larger account and take 0.5% of that, what larger number do I need to make in order to make $20,000 a year? That's the way you figure out your vision for what you're going to be capable of doing. You start with the $1,000 account, and over the course of the year, you figure out what your metrics are and what your positive expectation is, and then you say, I'm making 1% on average per trade. In other words, $10 1,000. So if I had a $100,000 account where the pip size is $100, and I make that 1%, I mean, that's a lot of money, right? On a trade, that's $1,000. So the way that you construct your vision for your trading goals is to work with the smaller accounts until you have a large enough sample size of trades to have this positive expectation metric, whatever it is, win-to-loss ratio, or whatever metric you want to use. And once you have that, then it doesn't matter whether you're trading with a $1,000 account or a $100,000 account. The metric number remains the same. The expectation is the same, except the dollar value goes up an order of magnitude each time your bank size goes up. You increase your bank size by an order of magnitude, you go from $1 a pip to, on a $1,000 account, you go to $10 a pip on a $10,000 account. So the way that you make money in trading is gaining the metrics to support a proper vision of your trading and your ability as a trader. And then you step back from that and you say, how much money then would I need to have in my bank? How much would I have to trade? Would I have to trade a $100,000 account? Would I have to trade a $200,000 account? What would I need to trade? And you can work it out and you know, the metrics are worked out on a day trade type basis anyway. How much do you make on a daily basis? So if I said, well, gee, I'd like to make $200,000 a year. Oh, okay, well, what size bank do you need if you're going to make 5 pips, a 0.5% a month? How much money am I going to have in the bank to trade? A 0.5% a month on $1,000 is 5 pips, right? So if I wanted to make $100,000 a year, how much money would I have to make or trade with in order to make $10,000 a month? I guess, you know, you want to make $100,000 a year. That's the way you got to do it. Don't let these assholes tell you any different than that, because it's not providing you the ability to form the correct visualization that you need. It's vision. Vision is the key. That's what's going to guide you in your trading, so you don't do stupid shit and try to take a $5,000 account and run it to $20,000. You may be able to do that. I've taken a $5,000 account and doubled it in 4.5 months once. Maybe I could do it again. I don't know, but I'm not willing to take those kinds of risks to double my account in 5 months. I'm not out to double the account. What I'm out to do is have a very simple trading methodology that at the end of the year I can make X number of dollars based on the bank size that I have. And if I can do that on a $1,000 account, then all I got to do is push the chips to the center of the table, and I'll be successful based on my positive expectation, backed up by my metrics and backed up by a clear vision of what my trading goals are. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.